And you've seen numerous layer ones and dApps, we won't name names, where they launch to market at a very high valuation, the insiders dump, they go down, and they walk away with a lot of money. So where they get involved is when you see multiple Cardano dApps start getting multi-billion-dollar valuations. Because there's something for them to invest in, there's something for them to connect to, but not just exclusively Cardano. There's plenty of projects in the crypto space that have taken this viewpoint as well. And those are the ones I think will be here in 10 years and still in the top 10 in 10 years, like Bitcoin. And frankly, Ethereum as well.
Welcome back, everybody, to Altcoin Daily. Today, I want to update you on Cardano, on Ethereum, and on Bitcoin, to name a few. Is now the time to buy? Plus, we'll be talking about recent pressing news in general. Of course, you subscribe for daily videos, keeping you informed on the entire cryptocurrency space, so hit that like button, please. Let's start right now with Cardano. Charles Hoskinson, creator of Cardano, was a keynote speaker at Mainnet yesterday. Mainnet is a crypto conference and summit, which is hosted by Messari and going on right now in New York City. Cardano just recently completed a major upgrade to its protocol. It was successful. The keynote took place just hours before. Cardano really is gaining momentum despite cryptocurrency being in a bear market, I think. I loved the answer that Charles gave to this question. Ryan Selkis of Messari asks Charles, do you think VCs looking to deploy money overlook the Cardano ecosystem? I mean, why isn't Cardano attracting any VC investments? Listen to this.
Do you think that VCs overlook the Cardano ecosystem?
Some do, some don't. It just depends on the location. Is it a family office? Is it, certainly A16Z and others are like, Cardano. But you know, the problem is that we didn't.
Why do you think that is?
Because we didn't have any Ponzonomics for them. I mean, let's be honest here. The vast majority of VCs, let's just be honest, the way they approach it is liquidity. So they say, when is the token coming out? Where's the marketplace for the token going to be? Do I get an early distribution? How do I exit that early distribution when the retail people come in? And you've seen numerous layer ones and dApps, we won't name names, where they launch to market at a very high valuation, the insiders dump, they go down, and they walk away with a lot of money. You know, and so there wasn't a lot of Ponzonomics to offer, and it was a fair distribution of Cardano. It has a great Gini coefficient. It's one of the most distributed currencies in terms of distribution, so there was no insider distribution to go and sell. Some of these layer ones, which you guys track on your platform, the insider distribution is greater than 50%. So if you're a VC, you say, oh, wow, if I get involved in this, and I get 10% of the supply, and I could get 100x in 6 months. This is my favorite thing in the whole wide world. They look at Cardano and they say, well, where's that opportunity? We say, well, it doesn't exist. It's an egalitarian distribution. So I got nothing for you. But you know, they'll get involved organically because greed is their thing, and that's their fiduciary obligation to their LPs. So where they get involved is when you see multiple Cardano dApps start getting multi-billion-dollar valuations. Because there's something for them to invest in, there's something for them to connect to. So probably 2023, 2024, but it's important to understand that we have our own VC in the ecosystem, Catalyst, which has $500 million worth of ADA inside of it. And it's already funded probably about 1,300 different projects on Cardano, and it admits about 60 to 70 million per year, which is a realistic emission for where the ecosystem is at in terms of its need for incubation acceleration. The big issue we have in our industry is bizarre and outside valuations. You have ventures that are perhaps worth pre-money $20 million because you like the founders, get $1 billion valuation. That's not healthy. And the problem is they have an expectation of return, so where does the return come from? It comes from the retail investor who gets bamboozled and they lose 90% of their value very, very quickly. I've been in this space long enough to know that's not sustainable and invites regulation, and then ultimately it's going to be closed off. So the only ecosystems that are going to survive are the ones that value hard work, and the ones that actually take time to construct things and build communities and create real value and so forth, like what World Mobile is doing, for example, and what a lot of the other people in the Cardano ecosystem are doing.
Now, Ethereum just had a successful upgrade as well, the Ethereum merge. Now, Ethereum is proof of stake. So now that it's been a little over a week since the merge, let's check in on it What has changed? What are we seeing specifically for supply versus demand and future price appreciation? It's been a little over a week since the merge. If Ethereum was still proof of work, the supply of ETH would have gone up by about 100,000 ETH. Instead, the supply of ETH has gone up by only 5,000. This is a 95% reduction in net ETH issuance. So supply flow has gone down, meaning theoretically, if demand just stays the same, this should be good for price over time, let alone if there's greater demand. We can make this even more fun by extrapolating it out to years worth of issuance. Would have been 5.2 million ETH issued under proof of work in a year. This is only about 250,000 ETH under proof of stake. In dollar terms, at current price, that's about 7 billion under proof of work coming onto the market and only about 350 million under proof of stake. Absolutely insane. I'm going to make you even more bullish. Most of that proof of work issuance was probably dumped by miners since they had to cover operating costs. That's just the nature of it. Most of the proof of work issuance after taxes will probably be held/restaked since operating costs are significantly lower than proof of work. And for my final act, once the market heats up again and the average gas prices are back to 15 gwei plus, ETH's issuance onto the market will be net negative. Of course, as more ETH is staked, the higher average gas price we need to keep ETH deflationary, but more ETH staked is good for the price too. And by the way, regarding that VC question that Charles Hoskinson answered about Cardano earlier, about the greed of some people, particularly VCs, it's not just Cardano who does this well. Of course, Bitcoin didn't come from greed. It's the ultimate people's crypto. But also, how Ethereum started, Ethereum did this right too.
But not just exclusively Cardano. There's plenty of projects in the crypto space that have taken this viewpoint as well. And those are the ones I think will be here in 10 years and still in the top 10 in 10 years, like Bitcoin. And frankly, Ethereum as well. Ethereum was funded for 18 million. That whole ecosystem. It's easy to forget that, No VCs, by the way.
So, the market is down, yes. But if you subscribe to us, you understand that so many of these projects are continuing their momentum that they've been building now for years with integrations, with updates, with developments, with partnerships. Is now the time to buy? Well, that's ultimately up to you to decide. Make your own decisions, do your own research. I'll tell you this, most people wish they bought at the bottoms of the bear markets. But those thoughts only come in hindsight and usually to folks that were nowhere near the space when the bottom was being made. Let me know in the comments if you think we're close to a bottom, at a bottom, and if and what you're buying, or if you have buy orders set. So much big news is happening in cryptocurrency. Let me update you on things that you need to have on your radar. Tornado Cash, the ETH privacy mixing tool, which is getting sued by the US Treasury, their code is back on GitHub. The key takeaways are as follows. GitHub has lifted a ban on Tornado Cash, restoring the platform's code and profile to its website. Last week, the Treasury clarified that sanctions against Tornado Cash do not apply to its code. Tornado Cash addresses are still sanctioned, and interacting with those addresses is prohibited by law. So this sounds pretty good. Let's dive in a little deeper. Tornado Cash's return to GitHub does not mean that development on the coin mixer will continue as usual. All pages under the project's main profile are tagged as public archives, a status that could be lifted, but which implies that no further development is permitted. Quote from an ETH dev, "It looks like everything is in read-only mode, but that is progress from an outright ban." Tornado Cash's future remains uncertain despite these developments. Sanctions on Tornado Cash addresses that prohibit its use remain in place, but users can still access the service due to its decentralized nature. We will continue to keep you updated with stuff like this on this channel. Final piece of news. The CFTC, and this is something you need to know about. The CFTC is suing a DAO. Here's why DeFi users should be alarmed. The Commodities Future and Trading Commission has launched a controversial attack on a DAO, and it could have serious consequences for all of DeFi. So the CFTC has filed a civil enforcement action against the Uki DAO, a decentralized autonomous organization that subsequently assumed governance control from the leaders over the Uki protocol under the same charges. This case is significant because it marks the first time a regulatory agency has sued a DAO, and because the legal implications of the CFTC winning the case could set a terrible legal precedent for governance token holders of other crypto projects, including many DeFi protocols. So they're holding governance token holders responsible. The implications of this: by labeling the DAO as an unincorporated association, the CFTC has effectively stated that its members have unlimited liability and are fully responsible for any of its actions. This argument is especially concerning given that the regulator didn't care that the Uki protocol is a decentralized non-custodial protocol powered by smart contracts. As such, it can't comply with existing regulations designed for centralized financial entities, nor can it be shut down by DAO members or any other party. The CFTC winning the case in court would establish a legal precedent that could make it much easier for the agency to target other decentralized derivatives trading protocols like Synthetics, GMX, DYDX, Injective, Gains Network, and Perpetual Protocol, to name the top ones. If that ever happens, then these token holders that have voted on any governance proposals could become liable and subject to prosecution for the protocol's potential illegal operations. Of course, prominent people in the cryptocurrency space have spoke out against this, that this is terrible precedent to set, and we'll see what happens. Just like always, guys, we keep you informed on a daily basis. Subscribe to the channel, join our team. See you tomorrow.